Welcome to the investment committee. My name is Bobby Mascia. I'm here with Jordan Kaufman, Brandon Sisk, and Sean Cole. And what a month it's been. And this is a good opportunity for us to just talk a little bit about some of the things that we've been looking at in the market, as well as some of the observations that we are going to be making moving forward. So, uh, first, we're going to go through the update. Then we're going to go through some of the recent news stories just to peel back the layers of the onion and put some context around what's going on, and what better way to end a market recap than with charts and graphs.
Oh yeah. Thank you, Bobby. Yeah, as you said, it's been a wild month in the market. So I think it's natural to feel a little bit anxious, a little bit uncertain with this type of volatility in the markets. I think we're here to kind of tell you guys the facts, how we're looking at things, and what we're seeing in terms of trends in the market and recent events. So just looking at the S&P 500 so far, year to date, it's down about 10%. Just in the last month, down about 7%. And if we look at some of these major indices alongside the S&P 500, like the NASDAQ, the Dow Jones, the Russell, there really has been no safe spot in the US markets. We look at year-to-date performance, all of those major indices are down about 10 to 15%. Where we do see some reprieve from that is the Vanguard Total International Stock Index being up about 4%. So that's something that we're going to dive into a little bit deeper later on. But that is one spot in the markets where we've seen some resilience and a little bit of an uptrend still continuing, while a lot of these US markets have been down about 10 to 15%. Brandon, what have you seen in terms of some of these international markets, whether it's just the broad Vanguard Total International or some specific countries that we've been keeping track of?
Yeah, I think the one interesting point is, if you're reading the news and everything, you're kind of seeing that the market's, down, and then that's, the headline in your face. But it really depends what you're looking at. If you're looking at the S&P, that's kind of the case. But there have been some, opportunities internationally. Looking just at the Vanguard Total International year to date, up about 4%. But then there has been some countries and ETFs that have done better, and then some that have done a little bit worse too. So if you're looking at, Spain and Germany, those have really outperformed, that 4% from the Vanguard Total International. But then there's also been some countries that have kind of lagged behind. If you're looking at Japan, has only done about 1.4% year to date. So I think even with that, that's something we kind of always preach to, that, diversification for diversification's sake, or diversification's lazy asset management. Not just looking at the Vanguard Total International, but looking into the peeling away the next layer of the onion of, well, inside of that, what's outperforming, what's underperforming, or comparing it to the US. While Japan may have only done about 1.4%, but that's still a big gap between the S&P 500, what that's done year to date.
Well, I think one of the things to note is when the headlines start to go a little bit crazy, I think it drives everybody a little bit insane from the sense of doesn't matter where you sit on a political spectrum necessarily, but when you start to see the impact in the markets and you see the impact in the news cycles, I think it's jarring. And for us, it's no different, right? As much as we like to say that we're trying to be observant, we're trying to find where the safe havens might be or the opportunities might be. This has not come without us really being concerned about the headlines to redirect or identify where we can deploy clients' money. So I think I want to just put that context in here, because it's not just all about the numbers per se. It's also about where do we see, just from an emotional standpoint, the headlines moving to as we start to make these decisions with your money, because we don't want to just forecast those without the understanding of what that's going to do emotionally. Does that make sense, guys?
Yeah, I think that's good context to add. One other thing that I want to highlight on this page, the US dollar. We've seen the US dollar lose value so far this year. We had a statistic on a previous webinar that the strength of the US dollar has attributed to about 3% per year of US outperformance over the last 15 or 20 years. As we see this year, so far, it's down about 9%, and we're seeing the opposite of international outperforming the US market. So as it's been a benefit to us in the last 15 years, that US dollar strength, now that we're seeing some weakening in the US dollar, we've also seen some weakening in US markets. So it makes sense that that's kind of moved hand in hand in both directions.
I mean, this to me, the biggest thing here, as you know, we have these conversations with clients, and people express concerns about the markets. We look at the headlines. The headline is mostly talking about U.S. markets being down. So obviously highlighting the outperformance in parts of the international landscape is really just adding context to a story where, even with this policy, the market is kind of saying the tariff policy, where most of the negative performance year to date has been in the last month. And the tariff policy is kind of at the heart of that. If AI was the story of 2024, tariffs are kind of the story of 2025 for markets. And there's kind of a clear message the markets are sending that this is worse for the US market, whether it be because the market was trading at a premium or concerns on growth or whatever the rationale can be. And we talked about this last month. It is telling you with clarity where it thinks the better opportunities are right now. And investors, we believe that this is investor flows, because that's, we can measurably see that. And we hear CIOs and strategists saying that in CNBC commentaries, interviews, this is what we're seeing, and this is where flows are going. And we don't know if this is going to be long-term or not long-term, but at the end of the day, what it ultimately means is US markets seem to be behaving like they're in a bear market, while international markets are behaving more like a traditional bull market in a volatile environment. And that's just something to kind of keep your eyeballs on. We talked about it last month. If anything, it is more true this month, and we'll continue to monitor it for next month and, weigh in and see where things are. But this all comes as kind of a shift of the way the markets have behaved for almost 20 years. The US has been the darling and demanded a premium. And that seems to be something which is being debated in the market right now.
Yep. As Jordan said, I think tariffs is the topic of 2020 so far. So that's one of our recent news stories. April 2nd was deemed Liberation Day. So what exactly happened on that day? That's where President Trump came out and released a number of reciprocal tariffs on other countries around the world. The market reacted pretty negatively to that information. So we saw a bit of a sell-off in the following days after April 2nd. And since then, it's just been a bit of a volatile whipsaw. We saw President Trump had paused tariffs after that for a 90-day period on all countries except for China, leaving a 10% reciprocal tariff on all other countries. So off that, there was a 12% or 10% to 12% rally in markets. So it's really been a volatile last few weeks, and it's been a nonstop flow of news and a lot of whipsawing back and forth, as I said. And as we just went through, international markets have been kind of the safe haven through that last 3 weeks as this story has developed with tariffs and the 90-day pause. And right now it's been really a back and forth with US and China. Right now, we have put a 145% tariff on Chinese goods. They have put a 125% tariff on US goods. And Treasury Secretary Scott Bessent is telling investors he expects a bit of a de-escalation because he doesn't see those tariff numbers as being sustainable. So we'll see how that story evolves. But right now, the US and China are in a bit of a trade war with these tariffs. Anything that you guys would add to that tariff story?
Not that wouldn't take us off a tangent and get a little bit too heated between the four
Yeah.
of us.
I would say the only thing to add is China right now is actively going out and trying to be a friend to other trading partners, whereas the US has taken this antagonistic approach towards most and many of its trading partners concurrently while it has this war with China. That makes it very distinctly different from the first Trump administration, where China was the target and the policies and rhetoric was much, much more tame. And the rhetoric and approach to trade policy right now is much, much more disruptive. And so the market's reaction should not be I think, our shared view. The market's not overreacting with the volatility we see right now. The market's just digesting. And that creates opportunity because, as you just said, Sean, Bassett said, this is probably unsustainable. I think most market participants view it as that. I think the view is either this is going to be resolved and, we'll find some new middle ground, or it won't be resolved. We'll push the US and potentially global economy into a recession, and American voters will probably take a different view, which will placate some of this later, because I think it's pretty hard to view these policies as something which voters are going to want to sustain.
Right. And the
So,
uncertainty in between that time is just what's going to happen. What's going to be the unintended consequences in the interim that are going to impact long-term growth for,
1,000%,
yeah.
1,000% is how long, how deep, how, are we going to come up with solutions elsewhere? Are we going to come up with a solution here?
I
I
mean,
think
George,
that
we don't even have an answer if it happened tomorrow. If they said, you know what, off the table, tariff war's over tomorrow, there have been so many changes that
Mhm.
companies have made at the executive level that have slowed down future growth and future opportunity. So imagine that going now even a month, 3 months, 6 months, how much more that gets exacerbated. And I think that the uncertainty is where, the market's kind of pricing in.
Oh, 1,000%. And that uncertainty is it's gonna leave a bit of PTSD on market participants probably for a little bit, which is why the one thing I think is any listeners who are like, well, where does this go? The longer you draw out the time frame, the more optimistic we get. But as we look in the very near term, it's hard to see investors rushing back in with clarity, certainty, and optimism in the super near term. And so navigating that, how do we navigate that? I think that's an important and really, we normally try to talk more about the long term, but the short term is very important on navigating correctly and setting yourself up for that next big leg, which we think is in there. AI is still a thing. It didn't go away.
Well, we
There's
did.
still a lot of positive going on out there, but like you can either just sit passively and hope and manage, or you can come up with a more effective strategy to manage through and turn the volatility into a positive. And that I think is something that we're working really hard on here.
Well, Jordan, you always say, right? Market is a forward-looking mechanism, pricing mechanism, and a
Mhm.
lot of these uncertainties they get baked in on the at the very beginning. So we felt a lot of pain because of the uncertainty that's forecasted in the future. And to your point, whether or not there's clarity in a week or a month or 2 months, that's yet to be told, which is, why we're getting hammered right now.
Well, we're kind of at peak uncertainty, which I believe is coming up in one of those fancy charts and graphs.
Our
Until,
next slide.
no, I'm just kidding.
Yeah, also just recession worries. Goldman Sachs raised the probability of recession from 20% to 45% now. I think a bit of an eye has turned now towards the Federal Reserve on what they're going to do, whether they're going to start cutting rates. I think there's been some tension between Trump and Jerome Powell, and whether Trump has the power to get rid of Powell or not. So that has been a new point of stress for the markets. I think the Fed has been put in a bit of a tough spot. Tariffs can be inflationary, yet Trump is calling for rates to be cut, which is also a bit inflationary. So it's kind of a tough balance that Jerome Powell and the Fed are finding themselves in right now. Inflation's still above that 2% long-term target. And as I said, tariffs are also inflationary. So there's really no clear path forward or answer there. But
For context, the Fed, if let's say Jerome Powell was to leave, the options for Donald Trump to choose the next Fed chairman sits with the same people, the same group that are determining whether or not the interest rates should move or not, which is the irony of this whole situation. Is it's not just one person who's making the decision, it's the entire board, and you have to choose from that board as the next successor. So that just makes it more interesting in my eyes.
yeah, he's not able to appoint anyone that he would like. He kind of has a set group of people that he's allowed to choose from. So,
Well, Brandon did send his resume over, I heard.
I'm top pick. But yeah, I mean, even with that, from cutting rates or keeping them where they're at, it's hard to tell what the effect of the tariffs will be. One, they were on, then they were paused. So how do you even like take that into calculate what that might do to inflation? And that kind of just adds to the, level of uncertainty from, a company wide to, a policy decision too.
yeah, that's a good point. I think there's going to be a bit of a lag until we start to see any of the effects of these tariffs on economic numbers, especially inflation. So how do you start to cut rates before you really start to see the effect of any of that? So I think that's a good point. And yeah, as Jordan was alluding to previously, this is
That Jordan's blood pressure reading over the past 2 weeks?
Pretty
probably
much.
looks pretty similar. This is a chart showing investor sentiment over the last 15 years or so. So this blue line shows the percentage of investors that are bullish on the market. So you can see that it is kind of range bound. We've seen it as high as about 60%, and as low as about 18 or 20%. So at the current point, we saw it around the beginning of April drop to that 20% number. It's come up a little bit. Right now it's at about 25%. So we are definitely on the lower end of the spectrum of investor sentiment. And that just is a direct effect of what we've seen over the last few weeks with tariffs, with markets kind of whipsawing back and forth. The percentage of market participants that are optimistic about markets is on the lower end. And that tends to be when we see opportunities, especially as Jordan said. In the long term, we think there's still a lot of optimism to be had around markets. In the short term, in the next 6 months or so, as we see this news cycle play out, as there's more updates on tariffs, as we see new inflation numbers coming in, there is still a lot of uncertainty. But we look at these types of opportunities when investor sentiment is low as good opportunities, and it tends to be a bit range bound. We've never seen it really drop below 15%. So at that 25%, 20% level, it's kind of almost as low as it goes, at least looking over the last 15 years or so.
Yeah, if you look at the start of this chart, it's in 2008. That was the financial crisis, kind of peak uncertainty, and many investors' careers who are active. 2020, obviously COVID, we didn't see numbers get as low as they've recently got. We saw numbers get this low when Putin invaded Ukraine in 2022. This is not a perfect metric, but usually when you get bearishness down in this level, you kind of have the least amount of buyers and kind of peak seller enthusiasm. And so typically markets are going to try to find support levels when you start to see numbers, like this that are reflective of a bearish mood. So it's a good time to look for support levels for buying, and that's one of the things. And we've started, trying to get everything that we're thinking out on the walls of our office. And so, we've got all the buy levels for indexes and investments that we think are poised for the next 5 years. Where do we find those levels? Where are we thinking about buying them? And just being disciplined about it. And I think when you get a sentiment like this, you do want to have your buyers goggles on, and you just want to be disciplined about where you're picking things up and make sure you're not chasing things on, big positive days like when we had the 90-day pause. Markets were up, 9% in a single day. That was clearly a time when, you kind of want to take advantage of some repositioning opportunities as opposed to just straight out buying. So, now's the time to find the levels you like. If you have questions about that or what we're looking at, it's not a bad idea to reach out, and we're happy to share that information with you.
Yep. I believe that's all we have.
Concise, to the point.
Yep.
Exciting times. Certainly not for the faint of heart. But this is where fortunes can be made. And this is kind of, these are the environments that usually shake out investors. If you're having trouble, or it's something that, is causing unease, you want to understand how this might impact your overall plan, what you're thinking about. If you're a client who's, we put together a very comprehensive plan, you just want to know, hey, is everything still intact? We're happy to have these conversations. We know that transparency and communication is the way to get comfortable and make it through these types of environments. If you don't feel like you're getting the kind of communication or transparency, and you're a listener who's not already engaged with us, that's we've been through these environments many times. We know how to do this and make sure that people feel the right way about it.
Yeah, I would say the only thing that I would be aware of, to Jordan's point, we have been through these types of environments, even though every one of them seems like it's different than the last one. Two types of mentalities really are the ones that you have to try to manage and stay away from. And one is the mentality of, let me go to cash, let me retreat, let me hide. As we saw, the dollar's down almost 10%. Retreating back into cash also means you have to time your way back into the market. How do you do that? And is that a sound strategy? Usually not often does that work. That's, when you want to sell out the cash. The other one is the blackjack mentality. I'm going to win or I'm going to lose. I'm going to make a bet now and I'm going to put it down, and I'll know in a short period of time whether or not I'm going to win or lose. Where we really want you guys to focus on, because we've just have so many numbers that show that statistically the proven strategy is more of the chess game. Sometimes you're going to have to give up some of your players for the long-term win, for the long-term checkmate. And it's not about the moves that we make today to win the game. It's more about positioning ourselves for the game of life and how we can capitalize over that period of time. So when the markets do go down, to Jordan's point, how are we taking the stairs down and the elevator up? Because as we start to see some positive optimism, it's a lot easier to make some of those smart shifts to put you in a better position. So stay away from the cash and the blackjack. More mentality on chess.
Love it. All right. I think that's a wrap.
Listen, we still have 9 more days of April, so we'll probably have to wrap some of that into the Mays Investment Committee. But we appreciate everyone's time today, and we will see you next month. And hopefully, we will have better news to report and a little bit more clarity and a little less uncertainty. But for now, put your hat on and your seatbelt, and get ready.